Gather round. It's time for your Real Estate Chalk Talk with the Hittner Group. Listen closely as your coaches discuss the culture, the economy, and the political scene, and how it affects your home and your real estate investments. Real Estate Chalk Talk is where you learn the science of buying and selling real estate and the art of living in your home. Your education begins in 5, 4, 3, 2, 1.
Hey there, welcome to the program. This is your Real Estate Chalk Talk with the Hittner Group. HittnerGroup.com, Hittner Group. That's all one word, kids. HittnerGroup.com, 612-627-8000. 612-627-8000. Give us a ring-a-ling-a-ling. Be happy to have a chat with you about your real estate needs. And, of course, that first call is exploratory only, all with no cost and absolutely no obligation. 612-627-8000. Okay, got a surprising statistic, kids.
Wow. Get that out.
A surprising statistic. Guess what it is? What do you think? 11.5%. That's the number. 11.5%.
That's
New construction, new house start.
increase in new listing activity.
Very good guess, but no. It is the number of
foreclosures.
the percentage. No, the percentage of price reductions.
Wow.
11.5% of the current active properties have done a price reduction in the last 7 days. That's an indicator, and we've got I've got some stats here on the national level because I know Junior loves the national numbers. Average days on market through March, 47 days. So those longer, this is what this is reporting from Inman News, and it's a Redfin survey that they did. 47 days to sell, the longest stretch in 6 years.
The highest
47 days.
47 days, the highest in 6 years of days on market. So that tends to discourage competition, according to them, often signaling buyers to either wait or negotiate. It's a quick story. So we're working with some people, Calvin, you know them, and we're going back and forth over this house that they like, and they are thinking about making an offer. And his exact words to me were, "It's a buyer's market. I am not paying a premium for a house." That's the mentality.
It's a buyer's market.
See how that's turned around? It's a buyer's market. Whether that's true or not, that's not the point. The point is the perception in his mind is that it is, because this house has been on the market for 4 weeks and hasn't sold. And other homes in that price point that we're looking at have all been on the market for weeks and weeks, and they haven't sold. So his idea is, it's a buyer's market. So is that a self-fulfilling prophecy? I don't know. What's causing that perception is the longer times on market.
Mm-hmm.
Mm-hmm.
Now, interestingly enough, on the homes that have gone pending in the last 7 days, the days on market of the homes that went pending is 25 days. So you got homes on the market that are sitting, and then homes on the market that come quickly. I think that's skewed by those homes under 400.
Is that average or median number?
That's average.
Average.
Average. So, well, it's not. It's an average.
Okay.
Days on market of those homes that went pending. So you've got homes that are, maybe the 400,
Went
450
really fast
that go in the first 24 hours, and then you've got the bigger homes that seem to be lagging.
Yeah, taking a little extra time.
Yep, they're taking a little extra
We're
time.
seeing some homes even get accepted with contingent offers right now.
Yes.
That was surprising to me. We went in with a couple, and we got them. They're like, okay.
Yeah, I had a conversation with Lennar this week.
Okay.
And about a property that they've got, a ready-built home that they've done a significant price reduction on, and said, would you take a contingent offer? And they said, yes, they would. And they would actually remove it from sale because they've got other ones in the development.
Oh, wow.
That they can sell. So they would actually pull it off the market, but they wanted $15,000 non-refundable earnest money.
Okay.
But that's fair.
Yep.
And then it gets applied. So now, are you serious about it, or are you just kind of testing the water? So I thought that was pretty decent. 6,233 homes on the market as of today.
How many?
6,233.
That's up.
That's up. That's up 19% from the first of the year.
Wow.
And we're at that's 15% still down from 2019, which is the benchmark, about 1,000 houses off, but still, coming along.
Steadily climbing.
Steadily climbing. So when you take that, now we look at Housing Wire. So Housing Wire reports that inventory is up nationally 32%. Now we're up this year in our Midwest metro market 19%, nationally 32%. Pended listings are up 2%. So that's quite a delta. So we got a 2% increase in the pendings, that represents demand, and a 33% of listings, that represents
Inventory
supply,
kind of, right?
Supply.
Okay.
So supply demand. That doesn't bode well for pricing.
No.
And what we see in our market is our solds through March are actually down 1%. Nationally, the solds are down 2%. So our market is outperforming the national market. I think we're actually in fairly decent shape, but it's really kind of flat. So then the question remains, and right now you hear a lot of people saying that it's the tariffs, is causing it, and the uncertainty is causing it, and this, that, and the other thing. But really, we're reflecting what was going on last year. And last year, there was no tariff talk. And last year, you know what I'm saying?
Yeah, it's pretty close.
It's a continuation of what was going on, and it's still mainly, I think, cost-driven.
Don't you think, though? I mean, we saw it. I mean, when when everything started getting really shaky, we saw things.
Oh yeah,
we saw people
take
pump the brakes a little bit.
They'll take a breath.
Not saying they're going to not buy,
Yeah.
but they're definitely like, yeah. So I work at the VA, and I'm just not sure, or I work here, and our stock market just went down, and we don't want to pull money out now because we're going to pull it out here, and then we're down 20%. So we've seen some pumping of the brakes a little bit. So I don't know.
I think that's, Calvin, why you're going to see people wanting to do contingent offers as well, because they're going to want to take the money out of their existing home and move it into their next address, rather than pulling money out of the market and bridging that gap themselves.
It's true.
Because they're locking in their losses there.
Yeah, I signed a couple listing contracts in January, and now we're about to come on the market. And where we had the price set kind of off market in advance, we're coming in a little bit lower than what we had initially priced the property at, just because of there's a little bit of a slowing of the market compared to what we saw right at the beginning of the spring. So we're just being a little bit more careful on what we list the properties for right now.
Isn't it interesting? Because we would have rewind the clock. We would say, hey, do it now, right, in January, February, because come spring market, we're going to be off the race.
In terms of buyers?
Yeah, just like act now, but now
the prices
they would have waited.
The prices are still up. The average sale price, the median sale price is still up.
Yeah.
So, yeah, it is. So there's that. And that's where you've got your hesitancy. So part of the thing we talk with tariffs is it's going to, we got lumber that comes in from Canada with tariffs. We've got sheetrock, or a lot of wallboard and stuff that comes in from Canada. There's tariffs. You got appliances that come in from China. There's tariffs. You've got electronics that come in from Singapore. It's all these tariffs are coming in. So then I thought, why don't I just find out what is our capacity? So I did a little research, and I find that Weyerhaeuser is the largest lumber mill in the world. It's Weyerhaeuser. They have the largest standing lumber timbers in the world, is owned by Weyerhaeuser. So we have the capacity.
I'm not familiar with.
Well, Weyerhaeuser is all over the place, but I don't know where their headquarters are. It doesn't matter. Because they've got 100 or 200 facilities.
Really? Okay.
But it's a national company. It's a U.S. based company. U.S. Gypsum's a U.S. based company. They're the largest provider of sheetrock. Durarock comes from U.S. Gypsum. Sheetrock, the brand.
So maybe it's not as big a deal.
I think that that these companies that have the capacity that are now bringing product in from other places because of cost are just going to fire up their plants because they've got the capacity. So it's how fast can you turn that over? One exception to that that I was looking at, I thought, well, what about? I was thinking, what are the components of a house? It's cement.
Right.
Where is the largest producers of cement? Lumber, sheetrock or wallboard or that kind of stuff. Wire and cable. The largest producer of wire and cable in the world is Italy.
Really?
Italy.
Really?
Yeah. And then the second largest, I think, if I remember right, is India. U.S. has one that's like we're like in 10th place.
Interesting.
So it's like, okay.
That's probably fascinating.
It was very fascinating to look at just where all these
products and
what I was
materials are coming from.
Yeah. What I was looking at is components. Like, where do you get components? So I'm talking to somebody else. We're running out of time in this segment. I'm talking to someone else about that. How can you worry about cheating on the tariffs? How can you get around? Well, they'll ship from Singapore or from China to a company that has an agreement, relabel it, repackage it, and then bring it in from that country and avoid the tariffs.
Workarounds.
Yep.
That's all right.
Yeah, got to do a workaround.
Oh, we're going to get to work here and head out to break, pay some bills. This is Real Estate Chalk Talk. Log on to hittnergroup.com. Give us a call, 612-627-8000, and we'll be right back.
We got Dave in here from, what's the name of your insurance company?
Insurance Producers Network, Rogers Agency.
Rogers Agency.
Yes, sir.
Okay, so here's the big question. Keith and I were having a conversation 2 weeks ago. I don't even know if you remember it. We're talking about probate.
Yep.
Real estate. And I said, I'm working with files right now that we're reaching out to the personal rep because the house has not sold. It's still being transferred. I've talked to a couple of, I'm thinking of a couple of brothers right now, who their dad died. They got a house in southeast Minneapolis University, so they're renting the house. It's still in Dad's name. Still in Dad's name. They haven't transferred anything, so they haven't closed out the probate, but they're renting the house out.
They haven't submitted the death certificate in. They haven't done any of that.
Well, that's all been done. The probate has been filed, but it hasn't been closed. So, in other words, they haven't liquidated the
hasn't been transferred
of the estate, and they haven't transferred the property. So the property still remains in the dad's name. And I'm thinking, boy, that's a risk. We talked about it from a mortgage standpoint because now you've got a mortgage with a due on sale clause. You've got a owner that is deceased, no longer the owner. You're making payments in the name of the owner, and that seems to be that's a direct violation of the contract. Is the mortgage company going to chase after them? Well, no, because they're getting
the payment
unless something goes wrong.
Yep,
it's always unless something goes.
Right.
It's always good until it isn't. So then my question is well, what about the insurance? Because right now insurance companies are under the gun.
Oh yes.
So what kind of because there's a natural flow of things. I mean, people, they pass away, it goes into the estate. You've got to maintain the property.
Yep.
So, how does that work, and what kind of reporting or notice is it required for the insurance company?
Yeah, you asked me that question a couple of weeks ago, and I did a lot of research on that, and the answer is kind of scary.
Okay.
Depends on the carrier. Okay. And I was going to qualify that. Sure. It always depends on your insurance carrier. But some I talked to said when mom or dad or aunt, uncle, whoever passes away, that policy ceases.
Oh.
You need to get a vacant.
It ceases.
It ceases. Some will say we'll non-renew at renewal. So you might have a time frame there for the renewal.
The renewal, is that like quarterly or is it an annual?
It's an annual.
Okay.
Homeowners insurance is always an annual.
Okay.
So depending on what carrier you have,
Sure.
it could be immediately or it could be 6 months, 8 months, whatever. Yeah, whatever that time frame is.
Okay.
You then need to rewrite that policy to a different policy because the insured, kind of like the mortgage company, you don't have the right person making that payment. You underwrote that gentleman. Same thing the insurance company did. They underwrite that person whose name is on the policy. That person doesn't exist anymore. So now it's a vacant home in their eyes.
Right.
So now you have to go get a vacant home policy or vacant dwelling policy. And obviously we have carriers that'll do that, which is
what if it's not vacant, Dave?
Well, then we've got other issues too. Whose name is
because you got somebody renting.
You got someone renting.
Somebody's in it.
Yeah, there's other issues there. So now it's okay. The house is still in John Doe's name.
Yep.
Well, John Doe doesn't live there. Who am I underwriting? Who am I underwriting that owns that home? How do I view that? Now, if it's in the estate name, there are things we can work around. We do have carriers, again, that will look at that and take care of that. But, again, the titling and everything with the city, the state, the county, whoever the title, wherever that's at, we've got to work with that and stuff. So there's issues there to make sure that there's an insurability issue, right? We've got to make sure we have an insurable property. But typically it's a vacant home or vacant structure. If no one's there, if someone's living there, we've got a whole nother ball of wax, right? If they're renting that house out or something like that. So is it in an LLC? Is it in a S corp, or how is that home titled?
Well, it's not titled. That's the whole point.
Right. Yeah.
So that now you've got some family members saying, hey, let's just rent it out, and they leave it in Grandpa's name.
Yep.
And now there's a hailstorm.
Yeah.
Or a windstorm.
Right.
And you've got a claim, and they find out that Grandpa's passed away a year and a half ago or 2 years ago.
Yeah.
And some of these it's like 2 years, and I know they're rented.
Mm-hmm.
And you got Johnny and Susie are living there paying rent.
Yep.
And now they go to file a claim.
Yep.
What happens?
Who's been paying the premium? That's the first question, right? Who's paying the premium? The estate, or is it?
No, it'll be paid by
little Billy and Susie are paying it.
Billy and Susie are paying it.
Billy and Susie are paying it. Well, are they named insureds on that policy? Who's the policy name in? That's
Grandpa.
The dead guy.
The dead guy. There's a legit reason that the insurance company could say, well, we have there's no insurable interest in this policy for Grandpa because Grandpa is not here anymore. They could legitimately deny that claim.
So then, all right. So now you bring up a good point.
So we started with 11 minutes, and basically at the end of the day, you're going to deny the claim. Keith.
You're going to deny the claim.
What else you got?
No. Well, now I want to know is the workaround. So
workaround.
So that we haven't transferred. Yeah. So who's the name insured on the claim? Could I notify the insurance company and say, look, the property's vacant. I want to be named insurer on the claim. I'm going to be making the payments.
Yep.
Grandpa's dead. The property's still in their name. Would that insure the property then?
Yeah. So again, it's going to go back to that titling though too, right? We got to get that title changed too to either the estate. We can name the estate as the insured.
Okay.
We can name an LLC. However that wants to get changed.
How do you do that?
That doesn't require any transfer of title.
Right.
Okay.
Yeah. Yeah. So it doesn't necessarily require transfer of title, but we just have to have a named insured that we're underwriting, that we're looking at.
How do you insure an LLC? It's not an entity. It's just an entity. It's not a person.
Well, you can have a checking account in the LLC's name, and they're making the payments.
Yeah.
So it's just like a person.
And they have an interest in the property.
Yeah, they have an interest in the property. They're the owner of the property now. So
they actually aren't. I thought it was based aren't.
They can be though. They can become the owner.
Yeah, but they're not.
They're not. So again, they're
the owner of the stream of rents.
Yeah. So there's a lot of different. Yeah, there's a lot of things that work there. I mean, there are options and there are ways to get it covered, but it's not as cut and dry as, hey, I'm buying a house, I need insurance, my name's on the title. We've got a lot of things we've got to work through.
And it's not good just go ahead and keep making the payments.
No.
Right. Yeah.
Because you might be making payments to something that isn't going to provide you any benefit at all.
Correct. Yeah.
Any benefit at all.
Yeah.
So, okay, well that answers that question. That's exactly what we
I don't know if I answered it.
I figured that there was
I'm not sure you answered it yet.
No, but
basically the claim's going to get denied.
I think in today's world, in the light of what's happening with insurance companies, probably so.
Yeah, and it goes back to your scenario too, or not even scenario. What's actually happening, where there's a house being rented for the last 2 years. Mm-hmm. Grandpa passed away, and someone's in there renting it. It's still in Grandpa's name, the insurance policy, and again, that policy in Grandpa's name is probably for an HO3 policy, not for a dwelling policy where it's being rented.
Absolutely.
So you've got the wrong policy anyways on the house to begin with. I mean, so there's a lot of things that work in that scenario. The insurance company has a legit reason to say, no, you've been renting this house for 2 years. That's the wrong policy. We're underwriting the wrong risk. Yeah. We're underwriting the wrong thing.
And the tenants have to have their own contents coverage.
Yep.
And all
so
that
the contents
stuff,
would be there exactly. Yeah. So you'd have an HO4 for them. You need an HO1 or HO2
landlord policy.
Yeah, landlord policy. Yep.
So then that brings up another case where we see a lot of where there's the decedent's name is on the title, but also his kids are on title.
Yep.
So now you've got a case where they are actually on title. They do have a right, but they change the use.
Yes. Yep. The use has to be changed. You're not a homeowner anymore.
Right.
You're a landlord now.
Okay.
You have to have a landlord's policy, just like Keith Jr. just
said.
So
same thing. That claim could be denied as well. Because now you're
you're
using it as income property.
Yeah. So my mother-in-law passed away back in August. My father-in-law put my wife on his deed.
Mm-hmm.
So now she is part owner in that home. Mm-hmm. So if and when he passes, we're set up. Yeah. We just write a different policy upon his death. So we're taking care of that home.
You missed a step up, though.
Yeah, I missed a lot of steps up.
Yeah, no, that's probably a mistake. But.
Yeah.
Okay. All right. Anything else, Keith? What do you got to add to that conversation?
Not that particular topic, no.
Okay. All right, so when we come back, we're going to go into, you got anything else you want to add to insurance in general? Is it getting easier? Is it getting harder? What's going on?
You're finding people need to raise their deductibles. Most companies are going to a 1 or 2% deductible. You've got a lot of people getting their renewal declarations, finding that out that, wait a minute, all of a sudden I got a 1 or 2% deductible. That's going to be coming down the pike for most carriers. You're going to go to depreciated value on the roofs. Once it reaches 5, 10, 15 years, depending on the carrier. So be aware of that. We have carriers that we can extend that to 15 years. Give us a call. We'd love to talk to you about that. You can reach me at Dave Rogers at mnipn.com is my email. Phone number 952-484-7615.
Perfect. Always fun to talk about insurance. We'll talk a little bit more when we come back from this break. This is Real Estate Chalk Talk. Log on to our website. Hittnergroup.com, Hittner Group.com, or give us a call anytime, 612-627-8000. That number again is 612-627-8000. We'll be right back.
Hey, welcome back. Thanks for sticking around. This is your Real Estate Chalk Talk with the Hittner Group. The two Keiths, Keith and Calvin, KKK. 612-627-8000. 612-627-8000. One more question for Dave Rogers. Rogers Insurance. I'm talking about associations. So we sold a association property, really nice townhome. Mm-hmm. And you get the insurance stocks back, and we're looking at reserves. Actually, a couple of them. And it's shocking to me how low some of these reserves are.
How low they are.
Really? It's like, oh my goodness, you're barely bringing in enough to cover snow plowing and all that. So when you got a roof, replacement, you have like zero money. It's all going to be assessed. So then we look at the insurance policies on these, and there's massive deductibles on these insurance policies. Yes. And it's like, well, how much can you cover?
Yep.
Can the individual cover for that deductible amount?
So that's going to vary by carrier to carrier. I've got one carrier right now that they used to have $20,000 to $50,000 of loss assessment coverage. They've cut that coverage down to $4,000.
Oh wow!
They basically are saying we want nothing to do with HO6 policies.
Okay.
We still have carriers out there that are $25,000 to $50,000 with that loss assessment coverage, but that is becoming a huge liability on their books right now because, again, you do have those large associations with $100,000, $200,000 deductibles per building potentially that could be assessed to the homeowners. So there is a major gap there right now on a lot of policies that people aren't aware of as well if they have a condo or a townhouse type situation.
So then, Kelvin, let's ask about financeability then of a property like that. When you've got an association with like no money in the bank or not enough, and then this huge deductible, and then your individual can only cover so much. You got a $10,000 or $15,000 gap there. How does the mortgage company look at that?
Well, we have at Loan Depot, we have a condo department that will review the reserves, make sure they're solid. Yeah, that they're adequate. But then, like we talked on a couple different deals, loss assessment coverage, have to have it on there, and then you have to make sure it covers the amount.
Yeah,
and if it doesn't cover the amount, you're not going to get financing on it.
No financing.
So we have a lot of. we're getting a lot of these right now because a lot of companies don't even allow. A lot of companies will say Freddie Fannie don't even allow the loss assessment coverage. So it has to be we have a workaround, right?
Right.
That we use, which is great, but still you have to have that coverage, and then we'll cover it. But sometimes there's gaps and there's deals not getting done right now, and that's why we had a couple deals where they were looking at townhomes and and they're like, "Yeah, I'm not going to get into that mess," And I was surprised.
When you've got some too that are looking at pending assessments.
Yes.
Yep. You've got something that's pending. What agent's going to want to write a policy where they know they've got a pending loss right off the bat for $20,000 to $30,000?
Yep.
I mean, I'm not buying a claim. I mean, and we're selling these policies at $600 to $1,000, and I'm going to lose 30 right off the bat.
Right.
You know.
So doesn't that tie to the original owner when the claim was
It's when it's assessed?
Okay, but it's assessed. Let's say it's assessed now.
Yep.
And now I'm selling my townhome. I'm still responsible for that, right? Not
when
the
it's
new
assessed
buyer
and when
coming
it's
in?
due. Yeah, I mean, there's a lot of language in there. Assess, due, all that. Yeah.
And I'll give you to your point, Kelvin.
Okay.
What we're doing now, we're asking for the minutes of all the meetings for the last 2 years, because something that's going on like this, because you got about a 2-year window from when an event takes place until the
2 years
can be filed. So you look at the minutes for the last 2 years. That's been
Right.
There's been conversation about that.
Yeah.
And if there's conversation about a loss, even though the loss hasn't moved forward yet and it has not been assessed, because it's when it's assessed.
It's going to be.
Yeah, it's going to be. And so it needs to be addressed then. That has an impact for us on the saleability of that address, because it's, it might be
So it's when it's assessed, not when it was first.
not when the occurrence happened.
Not the claim. Not the claim date. It's the assessment date.
Yeah.
Interesting.
Yeah, because think about this. The claim date may be a year after the event.
Right. Yep.
So
you have 2 years to claim it, right?
Because you got 2 years to claim it.
Yeah.
Okay.
So that's like
Depending on the
limbo
carrier.
land.
Depending on the carrier.
Depending on the
Could be
carrier.
only up to a year. Some carriers too.
So yeah, so the point is when you're getting into an association, there's 2 points. First of all, work with somebody that knows what they're doing. That's number one. That's going to look at these things and pay attention to it and advise you on what's good and what's bad. And then the other thing is make sure that you can perform, because if you've got a $10,000 gap, you can say, well, I got $10,000. If something happens, I'll just throw the 10 grand in and we'll call it good. Well, that's wonderful for you, but what about the other 250 residents in that development? Do they have that 10,000?
Right.
Yeah.
It makes it pretty nasty. Keith Arena, what do you got coming on the market?
The association just goes ahead and assesses the individual homeowner then.
Assuming that the association has the money. What if they don't have the money?
Right.
Then they got to go borrow it. Maybe they don't have the ability to borrow it because the bank looks at their assets and they say, hey, you've got no money.
Your monthly dues are not enough.
Right.
Yeah.
Right.
Then you have an association in disrepair.
In complete disrepair. We have not to keep on beating on this, but we have a condo building that we're working with some people that own in there, and she was wondering if she should move, and we were talking about, so what's your dues? They're $650 a month.
Holy cow.
Wow. What would you got? Car washes and a gym and all that stuff? She said, no, it's an old complex that under-reserved, and now they're trying to make up for it.
Yep.
And they've got some roof work that needs to be done and some boiler work that needs to be done, and there's no money.
Yeah.
And so all of a sudden their dues go from that nice $199 number that everybody liked to $650.
They're paying that for too long.
Yeah. So try to sell that bad boy.
Yeah.
Just no one's.
Yeah, I was going through some townhouses in Eden Prairie and came across that scenario where there's just one particular association and the values in there are significantly impacted.
Oh yeah.
So they're reselling probably like $80,000 less than other similar townhouses because the dues on them are so high. So they're balancing that out. We've seen situations where the city steps in with like a bond for the development, and then they improve the development. So they're basically borrowing money from the city,
right?
Because they can't get any money anywhere else. And those developments, overall values in those developments are significantly depressed on resale because of that situation.
Because of that, and there's only so many dollars allowed per month on a family budget for housing.
Yep.
Right.
And, if you've got something that's got a bunch of assessments on there, then some of your housing money is going to go to that.
Yeah.
And so that impacts the value of your
Yeah,
house.
You got a budget for that dues going up every year. You've got to start budgeting for that too now.
Yeah.
So the cost for those folks buying in that development is similar to going and buying in a newer development or one that is managed better.
Yep.
Because the association dues just impact that. So the values are down, but you're still paying the same per month. So it's really not real. I mean, you have to almost get under that depressed value in order to kind of take the risk, if you will, for that buyer coming into that development.
And there is the newer associations, or actually all associations, pretty much now, except for very old ones, are required to have a loss assessment survey or maintenance every 3 years. I mean, so they have a third-party independent company come around, and they look at that and they say, okay, here's your maintenance plan, and make sure that they're reserving enough and they have adequate reserves for the things. You look at the financials now, and it isn't just one big number anymore. They've got, that's broken down. This is for this. This is for this. This is for driveways when we need it. So it's pretty good there. So mostly what you're looking at, I think, when we're talking about these situations, at least in my experience, it's been older associations that came in before the laws changed, and they like those low dues, and everybody loved them at the time, easy to sell, until the piper, comes to pay, and then you've got that. All right, so Dave Rogers, contact information one more time.
Dave Rogers at MN. Let's start that again.
Okay.
Dave Rogers at MNIPN.com. Phone number is 952-484-7615. And my new really designed website is RogersAgencyInc.com. That's RODGERS, agencyinc.com.
All fancy schmancy.
All property and casualty insurance?
Yep. All property casualty, yep. Commercial.
Anything different with cars going on? We talk a ton about housing and all the issues that are happening there, but
good point.
Cars get beat up in hailstorms and stuff like
You've got a lot going on in the auto industry right now. Yeah, you've got smart windshields and stuff. It's really nice, right?
Those are expensive.
Those are very expensive, yeah. So you've got like the heads-up displays, or there's a lot of different things with windshields now that you would never think about, where it's actually very integral to the structure of the car. Plus, there's a lot of different things into that windshield now, where you actually have to go and have the car recalibrated after getting a windshield replaced.
Yep. I just had it done on a Denali, and it was like a, whatever the newer Denalis are, and had to replace the windshield, and they're talking about recalibration and all this stuff.
What does that do? What's that for?
Because it's a windshield.
It's a smart windshield.
Yeah.
It's like another.
So when you do the full glass coverage, it's a little bit more expensive than to take care of those things. So
absolutely,
I was curious about that.
$3,000 to $4,000 now for a windshield. It used to be $300.
Yeah, it's crazy.
Jeez.
Yeah.
All right. Well, we're going to head out to break here. You can find all our vendors at hittnergroup.com, HITTNER group.com, or give us a call anytime, 612-627-8000. That number again, 612-627-8000.
Hey, welcome back. Thanks for staying with us. The big money segment of the program. This is one that everybody usually, some people stay and listen to it because
I think most people.
Calvin's silky smooth voice.
Just wait, Calvin's smooth voice.
They stay here. Kind of get her cleared out.
Yeah.
I do that the first 3 segments, so now I'm just really
smooth and ready to go.
All right. Well, I'm happy to see everybody here.
Yeah,
in the 4th segment, because with the major decade storm that we just experienced in Minnesota.
God. Did you take pictures of it?
3 days of hype.
Yep.
And it was sunny, and I went for a run with my son for the first time. I ran.
Good job.
I can't run.
No.
Here's what I determined. I can't run good.
I can imagine the coordination is a little off.
My gosh, I can't believe how awkward of a person I am. You guys probably all knew that.
I knew that.
But then, man, he's like, no, let's go for a run. I'm like, it's just a mile. Just do a mile. Then it's like 2.2, and I can't even make
that. That reminds me of when this guy talked me into running a 5K.
I remember that.
Gassed out. He lapped me. He ran it twice. And still beat me.
Yeah, nice job.
Sure.
Nice job, young boys. No. All right.
It was crazy.
Anyway,
that's all that storm hype. So my kid's hockey was canceled. That's indoors. We can 17 inches of snow. We got hockey in the wintertime.
Yeah.
And now they didn't have hockey
because of rain.
My daughter's volleyball also indoors. That was canceled.
Yeah. Everybody's.
Why are they canceling everything?
It was unbelievable.
Softball size hail.
Conspiracy theory.
Yeah.
Unbelievable.
Something was going on. They didn't want people. They wanted you to shelter in place.
That's right.
There's something going on. And the only guy that had damage, senior, had a little wind, and
didn't even have any wind. The tree just fell down
because
it was afraid.
Yeah. It was. I give up.
Yeah. Saw the news reel running. Heard it on the radio. And
3 days of this, I'm done.
Fell down.
I'm not going to get hurt by this. I'm falling down.
Might as well.
So anyway, I'm glad everybody made it safely through the big storm of the decade. Question for you. I got a bunch of stuff today. Question for you. My road is being replaced in my neighborhood.
Good.
I pay property taxes at a reasonably high rate, I believe. And I was also fortunate enough to receive a bill for over $3,000 for said road.
Okay.
Why would I pay that when I pay property taxes that is for my road? and where's that money going? Why? I mean, you look at how much money they're collecting, $3,200 from everybody in this whole area. It's like millions of, like, what's going on? Why am I paying that?
Yeah. Good question. Did you call the city and ask them for that?
No, I'm asking you.
Yeah.
That's why we do this show.
Obviously, your property taxes are going to pay for fire protection, police protection, normal kind of...
And your schools.
And your schools. Normal kind of maintenance on the road. So if it was a minor repair... you would not probably have been assessed.
They plow your streets, don't they?
And they plow your streets. And
well,
when you flush the toilets, the water goes somewhere. It doesn't kind of run out the backyard. All of that gets paid for by property taxes. When they do a major rebuild like that, that's a capital improvement.
Actually, your toilets and sewer is included in your water bill. So
you're right.
The water bill is also includes your sewer stuff.
So anyway, super crabby. I was talking to my neighbors.
I have a large assessment on properties that I own too. Like, I think everything has an assessment. So I got a new street on there, the rental property. So they're all
really
assessing.
So, and you have the option. You can either pay it or they'll add it to your property taxes as a loan at
with the little interest.
10-year deal or something like that. So it's actually a little cheaper way to do it. But I just thought that was ridiculous. We have a new bridge loan, so excited about that. So people who are wanting to
put a bridge in,
not put a bridge because the county would
assess for that. That's bullshit. Right.
So no, a bridge loan to help pull equity out to buy my new home to come in and purchase. Same thing again. We have a couple different programs now that we can do that. So if you're contingent on the sale of yours, but you have a lot of equity, the key in all this is you have to have equity in property A to be able to access it, because they're going to lend up to like 75% loan to value. So if your home is worth $100,000, they're only going to lend up to $75,000, and you probably have a mortgage on it for something. So sometimes there's, it sounds good, but there's no money there.
Yeah.
Right. It's like I don't have 25%.
Plus, you still have to be able
property.
to carry the payments.
Not necessarily. We have a way that we can get rid of that payment. As well. So, so we can get rid of some of this stuff. So. Just know that, is there a way to do it? The answer is yes.
There's some options for you.
There's some options. Are they expensive options? Absolutely.
Yep, they cost money.
Yep, so just to be straight, we've been doing this too long. Now we're just telling people the truth.
There's nothing free anymore.
Now, finally, 21 years. Now we're like, hey, guys, it's pretty expensive to do all this stuff.
It's just like free shipping.
Right, you're right.
There's no such thing. No such thing as free shipping, just so everybody's clear on that, because that $80,000 truck that pulls up in front with a guy that's making $110,000 a year is not free.
Yep. Yeah, he's not living off of trust. Yeah. So bridge loan, it's out there. We have ways to get you into that property, but I'll tell you, we are seeing contingent offers being accepted right now. We're seeing seller paid closing costs or contributing towards a little bit. Maybe we pick up a point. Point means percent. So maybe we get 1%, or like I like getting 1.5%. And I do this buy down deal for the first couple of years, and so it really helps on the payment. So a lot of fun things. We just need more. We just need more activity. Like you said, there's homes sitting on. We talked in the first segment. I think people pump the brakes a little bit. There's some uncertainty in the marketplace.
Yeah, how have you seen applications over the last 3 months?
Last 3 months.
What's the trend?
Really good. Like, this is going to be a great year. Good. Really good. Good. What happened?
What happened? Yeah.
And we're in the what happened stage right now. And now you're like calling everybody like, hey, remember you're going to buy, oh, yeah, we're decided to we need it. We're going to pull money out of the 401k, but the 401k went down by X. So we're going to wait. So, again, not bad. And it's the 100 days of Trump, right? So everything, if you watch News Nation, I enjoyed Bill O'Reilly was on with Stephen A. Smith and Cuomo. Is it Cuomo? How do you say that? Yeah. So they were on with President Trump last night talking through everything and had a ton of great guests on. It was really good. But there's just a lot of uncertainty that, he's trying to do some revolutionary things, and this is non-political. It's just like
just the truth.
Just the truth. And we had a call with our company too. They're like, hey, this isn't political. It's just like there's a lot of upheaval, and the reality is things are going to be unsettled for a little bit.
Right.
As Trump said, as everyone said, it's going to be unsettled for a little bit. There's good headlines, right? That we saw this week again, and lots of economic data and mixed messages, but not much change in bonds, right? So We're seeing action-packed calendar, but no major action in bonds. Another small victory for mortgage rates. So we're not making great headway. We're still in that same space, about high sixes. National average right now is 6.81 on 30-year fixed money, right? On 15 years, about 6.125. We're trying to get some arms in there again, but boy, there's not an appetite on that yet. No. But that's right around, it's actually 6.335 right now. FHA.
So you're saving like a half point roughly on an arm.
Yeah, and it's not worth it.
On a 3-year arm?
It's a 7-year arm.
Okay.
So anyway, so good activity, but rates are where the rates are. And I don't think, we had a call like understanding the markets and all this thing and it was a nothing call, right? It's just like there's uncertainty, things are going to be volatile. So when you get a deal, lock it down. If rates go down dramatically, we have a float down policy. We'll relock them at the lower rate. I mean, that I just gave you an hour and 15-minute worth of conversation. So it drives me, just say that.
Right.
And can we just move on?
This meeting could have been an email.
This meeting could have been an email.
That never happens.
No. Anthony Haish he's the founder of Loan Depot, went away for a while.
Yeah.
He came back. Okay. Our CEO now that was there is out. Anthony's back in.
Okay.
So he's in Washington, D.C. for the last 2 days. I'm sure you guys don't follow him, but he met with, is pretty interesting. Finish up the last 2 days. Productive meetings in Washington, D.C. Heads of the agencies, including CFOs at Freddie, Fannie, COO at Ginnie Mae, Secretary, HUD Secretary, FHA Commissioner. So he's just making the rounds, just meeting with everybody.
Seeing what they got to say.
Just seeing what they got to say and just saying, hey, I'm back. We're going to do some revolutionary things. We want to be on the same side as you guys. Where do you need our help? Because of the top 5 lenders in the country, nobody tends to try to partner with Washington and say, how can we help move your agenda forward?
Because Washington was always trying to screw them.
Yep. So he's, he's a big Trump guy, big Trump guy. So he's there trying to see if there's anything we can do to help and just to build those relationships and know that we're on their side. So I think that's always a good thing as well. I'm happy with, kind of how things are going, but we just need to get a little bit busier. Just got to get busier. So if you're thinking about refinancing, we've got a lot of refinances going, which is crazy, but I totally get it once I go through them, totally get it. Makes sense, right? So that makes sense. Purchases, we're not having any issues. We're running into some multiples yet, too, which is weird.
Some price ranges, different price ranges.
And we're getting in multiple officers, but we're winning with a contingent offer. So that means everybody must be coming in low.
Way low.
We're coming in at or above the sales price, but we're contingent on a really nice home to sell. So anyway, a lot of stuff going on. I'd love to have a conversation. Kelvin Kamink, Loan Depot, 651-231-2500.
And that's it for this week. Give us a call, 612-627-8000. We'll see you next week.